Hello, this is Benjamin Boatin from Sevenfold Solution. Sevenfold Solution is accounting classes we have online, and we also meet and teach students who are interested in accounting. After watching this video, I would like you to visit my YouTube page, Benjamin Boatin, like my videos and subscribe them as well. You can also visit my Facebook page, Benjamin Boatin, search for my page, Sevenfold Solution, join my page, share the links, and we all study accounting together. Good. Today I would like to talk about the double entry solution, the double entry system, the double entry system. I would like us to talk about the double entry system for recording transaction. The double entry system for recording transaction. Now, what do you mean by the double entry system? The double entry system is a system whereby transactions are recorded in the ledger account. It is a system whereby transactions are recorded in the ledger account. That is, one as a credit and the other as the debit entry in another account. Alright, so before we continue, I would like us to note this. The double entry principle, the golden rule in accounting, then the ledger account. When we talk about the double entry principle, the double entry principle states that for every entry, there must be a corresponding entry. Listen, it states that for every debit entry, there must be a corresponding credit entry. For every debit entry, there must be a corresponding credit entry, and vice versa. You must know this. You must know this. Now, the golden rule in accounting also states that you must always debit the receiver and credit the giver. What do you mean by debiting the receiver and crediting the giver in accounting? I wish you know this. I wish you know this, and I'll always help you in. But this is the basic teaching, so you understand it. Again, you also, okay, let me talk about this before we move on. Let me talk about this before we move on. In accounting, it is understood that when a customer is giving out money, in accounting, when a customer is giving out money, he will credit it, and whatever that comes in your account, you debit it. So when you are giving out money, you credit it, and when you are receiving money from other customers, you debit it. Thank you. Now, let's go on to talk about the ledger account. The ledger account, as I said, is the main account in preparing every transaction, and it is also an account where transactions are recorded permanently. We have three types of ledger accounts. We have the purchases ledger account, we have the sales ledger account, and we have the general ledger account. We also have the private. The general ledger account has two main types. What is the private ledger account, the nominal ledger account. Then let's talk about the private ledger account. Now, the private ledger account in itself also has two main accounts. That is the personal account and the impersonal account. With the personal account, good. So where we've gotten to, let me talk about this. The purchases ledger account is an account whereby transactions for purchases are recorded in. It is an account whereby transactions for purchases are recorded in. Then we have sales ledger account is an account or a book in which sales transactions are recorded in. Alright. Now, the general account. So, the general ledger account is an account containing all other accounts apart from trade payables and receivables. The general ledger account contains all other accounts apart from trade payables and receivables. Now, the nominal ledger also contains accounts of revenues and expenses. It contains accounts of revenues and expenses. Now back to the private ledger. Like I said, we have personal account and impersonal account. The personal account is an account in which business owners record their transactions. It's an account in which business owners record their transactions. We have the impersonal account. We also talk about the impersonal account when we move further. With the personal account, it has two sides. That is the trade payables and trade receivables. Trade payables are your customers. They are customers. They are customers that you owe. Do you understand? They are customers that you owe, or suppliers that you owe them. So assuming I'm a seller and I'm supposed to give my customers or suppliers some money, I need to pay them. So I need to pay them. It could also be that some customers owe me and they also need to pay me. So with the trade payables, they are customers, you owe them, that you need to pay them an amount. Then you have the trade receivables. With the trade receivables, it's an account open for an amount that is yet to be received, an amount or debt yet to be received. Then we have the impersonal account. With the impersonal account, we have the real account and the nominal account. Like I said earlier, with the nominal account is an account used to record revenues and expenses. Then the real account also is an account in which assets like tangible and intangible assets being recorded in tangible and intangible assets. Is being recorded in, it could be cars, motor vehicles, and other stuff. Yeah. Now, what do we mean by an account? Like I said, we've talked about account. What do we mean by an account? An account is a place in the ledger in which all information relating to an item is being recorded. An account is a place in the ledger in which all information relating to an item is being recorded. And this account that I'm talking of is being represented by T, the letter T. It's being represented by the letter T. Now, here is it. When you've been asked to open an account of, let's say, an item, like an expenses, you just draw your T, which is your account. Then the title could be any of the items we know in accounting. It could be trade payables, it could be trade receivables, it could be expenses, it could be motor vehicle. We have a lot of items that we can open an account for. Good. So with this account, on your right hand side you have the debits. The debits. Let's say inflows. You always record your inflows at the debit side. And the debit side most at times increases your account. The debit side. So we also have the credit side. Your credit side. Your credit side also decreases. The credit side of the account normally decreases your account. So like your trade payables. it decreases because you are paying out. An amount goes out from your account, it goes out. Then we also have the debit side. When you receive anything, you debit it. So we have the credit side of an account and we have the debit side of an account. Good. So you can record your particulars, the dates, particulars, and the amount here. So let's say you have cash sales. Your cash sales as 100. They are the things that you sold. So you record them at the debit side. As we are now starting, you would like to end there. So like I said, I would like to end here. Watch the video, ask yourself questions, follow me on Facebook, and also you can WhatsApp me for any information on 0577 345 676. 0577 345 676. Thank you.